Recently, I had somebody very special in my life who was very concerned about her future and what she would do 20 years from now. And I said, buy a house today. And this was a year and a half ago when rates were spectacular, and the purchase prices were very high. And this is when buyers were bidding tens of thousands of dollars over asking price. And so she was really worried about that. And I told her it actually doesn't matter, because in 10 years from now, the value of your home will double. And in 20 years from now, it'll double from that. And so in 20 years from now, you'll either have 3 times the amount of your investment or you won't. But you will have made either a rent payment or a mortgage payment of some sort during that time. But after 20 years, you'll walk away with 3 times the amount of your original investment.
Hello, everyone. Welcome to the Money Maverick podcast, the show that Wall Street doesn't want you to listen to. I'm Tim Turley, the host for today's episode. We're coming to you from the Money Maverick studio in Salt Lake City, Utah. Today's guest, Maverick, is going to help us with understanding the crazy mortgage lending market right now and how we can prepare ourselves to get the best rates and terms. Some of you know quite a bit about mortgages and how they work, and some of you, which is probably quite a few of you, probably would like to know more about how to get the best rates and how mortgages work. Sevy Hughes has a decade of experience as a mortgage loan originator, which has given him a ton of experience and wide breadth of knowledge on various loan products and how to work with underwriters, title companies, insurance agents, and real estate agents. And so we're going to be talking to him in just a second. Many of you know that in the past, on a couple different occasions, I've been not only a real estate agent, but a licensed loan originator. I did it to help clients during the pandemic, during the lockdowns, because so many people were doing refinances because of the low rates. But it's, I don't spend my time doing that anymore. So it's not something I spend time on, which is why I refer to experts like Sevy. Just to go over a couple interesting things I thought you might want to know about is the residential mortgage loans, or the debt in the U.S. At the end of last year totaled about $12 trillion. So we know that there's still a lot of loans going out, but not as much as before. And, there's a lot of talking heads on the radio and TV that say things like, any debt is bad debt. And I would respectfully disagree with that statement. As Sevy will talk to you, most people that say that any debt is bad debt, if you ask them how they paid for their home, most of them, probably 97% of them or more, did not pay cash for a $500,000 house. They leveraged the bank's money, or they're in debt. So sometimes leveraging debt, for example, through a mortgage loan, is a really good thing to do because it gets you what you want and allows you to live where you want and that kind of a thing. In just the fourth quarter alone of last year, there was 1.52 million residential loans that were issued by mortgage lenders. And that seems like a lot, but it was the biggest decline since 2014. And, there's some crazy things going on. At the end of 2022, the average balance nationwide for a first mortgage, it was a record high of $323,780. That's according to the Mortgage Bankers Association. And so there's a lot going on. We know we had the refinance boom during the pandemic, but they've slowed down quite a bit, which, again, our expert will be able to tell you about today. But there's lots of different types of loans, and I'm going to have Sevy go into that. So without further ado, I want to introduce Sevy Hughes. He goes by Sevy. He has such a cool name. You can pronounce it 2 different ways. Welcome to the show, Sevy. Thanks for being our Maverick of the week. And I wanted to have you give a little background of your experience in the loan industry. And I know from personal experience of you working with some of my clients that you just do such a thorough job, and not very many mortgage loan originators that I have ever met with go the extra mile. They're not aggressive enough in getting the best possible terms for their clients. And I think that's what makes you stand out. That's why you're a maverick, is you noticeably go the extra mile for people. And that's a nice, you're a nice person to have in someone's corner when it comes to mortgage loans. So even though you're licensed in, I think 1 or 2 states right now, maybe more, the information I know you can provide will apply to anybody listening, no matter where they are in the country or in the world. So again, welcome, Sevy. Give us a little background on how you got into the loan mortgage, residential loan business.
Thank you, Tim. It's a pleasure to be here today with you, and a special thank you for the introduction. That was very warm and welcoming. You made me feel like $1 million. I appreciate that. About 10 years ago, a little bit more, about 11 years ago, really, I was talking to a friend who got into the mortgage industry. And at the time, I was a contractor. And there wasn't a whole lot of difference in my perspective. I had to find clients. I had to provide a good service for them. I had to close and move on to the next client. And I really enjoy that. And the comparison from contracting to mortgages for me was all the same, other than in contracting, you have to actually build a physical product. And in mortgages, you're providing a service, you're attaining finances for somebody to buy a home. And there's a couple of things that you touched on in introducing me that coincide with why I actually wanted to get into the industry. And one of them is helping people get money to buy their home. That is probably the biggest investment. And you talked about leveraging money, so I'm going to use the word investment. The biggest investment that the average American has in their lifetime is purchasing a home. Along those lines, there's been surveys that show the stress of buying a home is equivalent to getting married or divorced. And I take that very serious. I understand that there are folks out there that sometimes I run into clients that this is really easy. It's an easy process. Others, it is very arduous for them. It's very emotional for them. There's a lot of attachments. There's a lot of stress. They may have never had a mortgage before. They might be going from $1,500 rent payment to a $3,000 mortgage payment, and that's a shock. And so I want to be there to walk them through that process and to give clients and borrowers, is what we call them in the industry, their options so that they can make the best decision that is beneficial to their lifestyle. And so really the reason why I got into it, Tim, is because it's just a very meaningful industry to me. I get to be a part of this. And I did not know the amount of debt that the nation was in mortgages. You said about $12 trillion.
Right, and that was down from that was a low from many years ago, and that's crazy.
Yeah, so I get to be a part of that on the good line. I mean, I'm sure at times we all feel like we're a bit of a slave to a mortgage. However, it is leveraging. It's leveraging an opportunity for us to have home ownership. That still is the dream, by the way. And it's definitely an investment, not only for real estate investors, it's an investment for homeowners. Recently, I had somebody very special in my life who was very concerned about her future and what she would do 20 years from now. And I said, buy a house today. And this was a year and a half ago when rates were spectacular and the purchase prices were very high. And this is when buyers were bidding tens of thousands of dollars over asking price. And so she was really worried about that. And I told her it actually doesn't matter because in 10 years from now, the value of your home will double. And in 20 years from now, it'll double from that. And so in 20 years from now, you'll either have 3 times the amount of your investment or you won't. but you will have made either a rent payment or a mortgage payment of some sort during that time. But after 20 years, you'll walk away with 3 times the amount of your original investment. And it's also interesting, Tim, that you talk about high interest rates and leverage all at the same time. To an investor, they actually usually don't care about the interest rates. What they come to me for is they're asking me how much money can they make a month off of a property. So the interest rate, that is a factor that we put in for that calculation, but more so, we are trying to determine what a house payment is and what current rent market is. And also if there's equity or value or opportunity to improve a property.
Oh, that's really interesting. Let me stop you there because that's a really good thing to pause on. You know, what we teach our clients in our planning process is what is the cost of something? You know, most people just look at the rate of return or the interest rate on a mortgage loan, for example, or what something is going out. But that's not the definition of cost. Cost is input minus output. It's what you get back from it. It doesn't matter how much you put in. So I love what you just said about how investors look at a property. They're worried about their cash on cash return rate, the rate of return of their money, not on their money. Like you said, they don't care what the interest rates are. If they're going to get a decent cash on cash return from the investment, who cares what the interest rate is? Interest rate could be 15%, but if they're going to make a 12% cash on cash return from the investment, that works for them, right? So
it does.
Yeah.
And it's
so that's, I'm glad you brought that up.
Yeah, thank you. And it really is an advantageous time to invest or buy. There's a bit of a cliche that you may have heard. We are married to the mortgage and we're dating the interest rate. So on that note, for investors and home buyers, investors know that if they can make money now, they can get a return on their investment now with interest rates, and I'm doing air quotes here, being high, because as you know, Tim, 7.5%, 6.5%, 8%, those are not high interest rates. Those may have actually been extremely low interest rates, depending on who you're talking to and when they bought.
Yeah, I'm dating myself, but when I was a teenager, the rates were 18%, 18 to 20%, and people still bought homes and invested.
And that's incredible to think about, really. Actually, I'm blown away. I hope that we never see that again. I really, truly hope that we are at the top of the interest rates. We might go a tick higher. If I could predict the future, Tim, here's another cliche. I'd be driving a Ferrari, right?
Right.
So, but investors know that if they can make money now when interest rates are higher, and they're just dating that interest rate, that in a year or two from now, they can refinance and actually make more money than they are now on their investment.
So we may, let's back up. I don't want to get too far in the weeds just yet with some advice from you, but tell us, generally speaking, for those that maybe have not purchased a home yet. Again, there's a purpose for renting and there's a purpose for owning. They have different benefits and depends where people are in life. So they have a purpose. But for first-time home buyers or people getting a loan for a residential property, which is going to be their primary residence, not an investment property, what typically are the requirements and type of maybe loan products that are common in terms of down payments and that kind of a thing? Can you just give us a simple rundown of what people can be prepared for?
Yeah, of course. When it comes to the down payment, I would expect or anticipate that a first-time home buyer should save up to 5% of the value of the property they're looking to buy. That may not be the best loan product for them. That's in reference to a conventional. So conventional loans only require 5% down. A little easier loan to get into for a first-time home buyer is an FHA for 2 reasons. One is they only require 3.5% down, but also they allow for a higher debt to income. So if you save up, let's say $10,000 to $15,000, you probably end up being around the 3.5% to 5% on the average home in the Salt Lake area. And I
And
mentioned
nationally, it's going to be different nationally, of course, but that's the market that we're in right now.
that's the
So
market we're
that's
in,
a good reference. Right. Yeah.
yeah. And I mentioned debt to income. That's also, Tim, that's a big one to be prepared for. So if I'm giving advice to a first-time home buyer, it would be just that, to see where your debt to income is. And what that is more specifically is it's how much income you make a month and how much debt you have going out a month. So it's not to be confused. Let's say we have a debt on a car. That's very typical. And the payoff is $20,000 on the car. Well, we're not interested on that for what your monthly debt is. Your monthly debt to income has to do with what the car payment is. So your income is X, and then your debt is Y, and those are what we compare for a month-to-month basis.
What about a credit card? Is if someone's making a $200 payment on their credit card, but the minimum payment is only $60 that's required by the credit card company, which one of those numbers is factored in?
Tim, that is a perfect example. It is the lowest required amount. So if your minimum payment is the $60 mark, that's what is counted. If you elect to make $200 or more, that's your prerogative, and good for you, actually. But we only compare what the minimum is on your credit report.
Okay, excellent. And what typically is on, let's talk about an FHA, since we're talking about that. On an FHA loan, the Federal Housing Authority loan, of the 3.5% down, what is an acceptable range of the debt to income ratio or percentage that they will allow?
So, first of all, that is actually a wonderful question, and that should always be, that's really a personal thing for somebody, what they want to be comfortable with, right? That's one aspect. The other aspect is, what are the guidelines? What does FHA allow? And FHA will actually allow you to go up to about 55% of your debt to income ratio. However, there's usually what we call compensating factors. Do you have a little bit of money left in your bank? And do you have good credit? Sometimes you can be denied at that high, but generally below 50% you can count on a more safe average 50% debt to income when going into an FHA. But like I said, sometimes there are cases where you can go as high as 55%.
Okay, and everyone always asks us, right, Sevy? They're always asking about the credit scores or FICO scores, the Fair Isaac scores, right? What could somebody qualify for nowadays with, in terms of the low end, and what's considered the high end that gets you the best rates and terms possible?
Oh, I really appreciate that question too, because that really is germane to what goes into a mortgage. Two things on that is, first of all, we'll talk about the interest rate, how the FICO score impacts the interest rate. And your FICO score, can range from 0, which doesn't really happen unless you don't have any credit at all, to about 850. Each bureau has slightly different cap, but 850 is the top. A first-time home buyer, or really any home buyer for that sake, could go down to about 620 on average. You can go lower. A VA has no restrictions, however, the banks do. So VA might say, we'll allow somebody to apply for a VA loan, and they can have, a 580 FICO score. But the bank comes over and they have an overlay and they say, we're sorry, we don't quite accept that low. But we'll do a 600 or 620 or whatever that lender may have for their requirements. 680 is about the magic number for the low end, where you're going to get a better interest rate. 700 gets you a little bit better interest rate, 720 a little better, 740, 760, those are usually the brackets. There has been an adjustment this year to what we call LLPAs, loan level pricing adjustments. And that would be based on what your FICO score is. So if the interest rate, today's interest rate is 7%, somebody with a 620 doesn't quite get that. 7%. They might have to pay extra money or go with a higher interest rate to cover the difference. Whereas somebody with a 760 FICO score, they may actually get maybe a 6.75% interest rate. It's kind of a reward for having good credit. Now, this year, the loan level pricing adjustments, it's a little bit of robbing Peter to pay Paul scenario, Tim, where actually those who have lower FICO scores, those loan level pricing adjustments are being waived, and they can actually get the same rate as somebody with a better FICO score. And then somebody who might have a higher down payment and a higher FICO score actually might be slightly penalized or not gain the same benefits as they did before. And so it kind of leveled out the playing field.
That's interesting. I want to ask you quickly about the investment requirements for an investor or a second home or investment property. And then I want you to talk about this really fascinating new product that's on the market now, where there's kind of a grant basically involved in the product that you were educating me on recently. So before we go into that, Sevy, what are the differences? What are the most important differences for investors? Now, again, as a money maverick, we teach people to be very knowledgeable and wise with their investments and to search them out and look for ones that have good cash flow return, whatever that is. And of course, one of them is a real estate property, whether it's a single family residence or a duplex or apartment complex or whatever it is. So compared to a primary residence, for someone's own home, someone coming in as an investor that wants to buy an investment property of some type, what are some of the most important differences on a loan, a mortgage loan for an investor that's different than a primary residence?
Yeah, that's also a very great question too. An investor should count on putting about 25% down on average. Now, that's a two-part question, really, Tim, because an investor can elect to purchase an investment property with a quality mortgage. And all the mortgages I've been discussing up to this point have been about quality mortgages. And as you know, before quality mortgages, that's what led us to the crash in 2008 and 9. There were no quality mortgages. So an investor can buy an investment property on a quality mortgage with 25% down, and those interest rates are generally quite a bit higher. And that's perspective on quite a bit. We might be 0.5%, just depends. They don't have mortgage insurance because they are vested more than 20% equity. The other type of investment loan is a non-QM. There's no quality mortgage to it. However, the banks are wise and they don't want to write bad loans. So they're written very much like what the federal guidelines would have to create a quality mortgage, but it's portfolio money. So the banks can decide how they want to approve and deny those loans.
What do you mean by portfolio? What do you mean by portfolio money, Sevy?
Well, it's investment money. It's not government-backed money. There's no protection to it, really. It's just investors that have put up coin to invest in good products. So it's portfolio money.
Gotcha.
And so those are the two different. So those loans that I'm referring to for investors specifically are called DSCR loans, and the lender rather, they can determine how many properties they're going to allow that investor to purchase in any given area. So in a declining area, maybe like DC, where there's a lot of people moving out, investor might say we don't want to allow that. But perhaps in a state where a lot of people are migrating to, the lender might say you can buy as many as you want. You can have 100 investments if you'd like. And investors call them doors, by the way. One house would be called one door. One unit would be called a door. So they can buy 100 doors.
Fourplex would be 4 doors.
4 doors. Yep.
Yeah.
And there's no limit on that other than what the lender feels comfortable lending. So those are some of the differences that they should know. And they should also really, this is a little bit outside my lane, but they should also really know what the market's going to yield for rent.
Right. Okay, good. So, and by the way, we teach people to build up an excessive amount of cash. right? The three E's that Robert Kiyosaki teaches: education, experience, and excess cash. And you've got to have some cash to be an investor. So that's why we talk about saving as the first principle. Now, tell us about this new product real quick that's just come on the market, which effectively, if you can explain it, it effectively requires a 1% down payment with some help, and how first-time home buyers can qualify for that. There's some limitations, but especially for first-time home buyers, it might be a good idea. Tell us a little bit about this product.
Yeah, I'll shoot some bullet points right at you, Tim. First of all, it's for anybody. You don't have to be a first-time home buyer. That's
Oh,
what's
good.
really nice about it. Yeah, pretty amazing.
Okay.
They do allow as low as a 620 FICO. The loan amount cannot be greater than $350,000. And so the purchase price, imagine, with this product, you only are required to put 1% down. That is absolutely incredible. And there's no repayment of the remainder, what you're not putting down. The bank is just giving this to the borrower. And so 1%, less from the 100%, it can't be greater than the $350,000 loan amount. Furthermore, which is just great, there's no mortgage insurance on these products.
Wow.
So having that affects the debt to income ratio. That helps you. Now, here's the one caveat to it is when you break it down to monthly income, because that's what we talk about most, whoever's applying for the loan, if one person or two people are applying, or up to 4 people, they cannot make more than $7,080 a month, or they exceed the median average income limit. And let me back up too. That is for the greater Salt Lake and Utah County area. That is not speaking nationally. So when looking to see if you qualify for that on income, you would have to check your local area to see what that median income is, and that you do not exceed what it is.
Okay.
So
Yeah.
in a nutshell, that's the product.
That's awesome. Before we get to the Money Maverick tip of the week, Sevy, and we really appreciate you having on and giving us some good insight right now. Oh, by the way, so as we're talking, we're talking to everybody, August of 2023. What's the current state of the lending market for a good buyer with, let's say at least a 680 FICO or credit score? What are the rates, as we're speaking of today for a residential mortgage?
Tim, answering that question would be like me trying to catch a BB out of a shotgun. I just made that up right now too, by the way.
That was pretty good.
That is a loaded question. So when quoting rates, you need to also talk about APR, which includes the cost of the loan. And but just on a basic rate sheet, if I'm not hitting any other triggers here, you can find rates as from the mid 5s to about 8%. And that depends on so many different scenarios.
Scenarios. Yeah.
Which, by the way, that you can count on that for a lot of investment products too. A lot of investment products are still hovering right around 8%, which is not bad. If you want to get a second mortgage or home equity line of credit, those are hovering right around 10.5 to 11% right now.
Yeah, and when we talk again next time, they're going to be different. I'm sure they will be. Then next
Absolutely.
time we well, Sevy, tell us where you're licensed right now, and you have a network of people all over the country, as you and I know. But right now, for people, what states do people live in where you can help them immediately?
Oh, thanks, Tim. Right, so I'm licensed in Utah. This is where I live. This is where I do most of my business. I'm licensed in Texas. I'm licensed in Colorado. I have efforts to be licensed in Idaho, North Carolina, and Florida as well. So we are expanding. When it comes to investment products, non-QM loans, those are the DSCR loans that we talked about for investors. I can do those in all 50 states.
Oh, excellent. That's good to know. We'll let you, we'll have you talk about how people can get a hold of you for information or advice, or to speak with you directly. But before they do that, if you were to give the Money Maverick tip of the week, one kind of a practical tip, it could be anything: how to prepare for a loan, how to get your FICO score, researching different loans, whatever it is. What is your Money Maverick tip of the week, Sevy, where somebody could start working on the area of mortgages right away?
Tim, the advice that I would give would be applied directly towards first-time home buyers, and that would be to have good income. So if you're coming right out of college, then we can count your new income and your past experience in college. But other than that, make sure you have 2 years of full-time work history. That's very vital, and that sometimes that's not easy to do. The other thing to do is to monitor your debt to income, what your income is, and make sure that your total debt and what a house payment would be does not exceed 45%. On all other debts not related to a mortgage, make sure that it's not more than 10 or 15% of your total income. And those two things right there are quite a challenge for a lot of people. So that's the best tip I believe I can give this week.
I love it. Thank you. And when we have you back on, Sevy, we'll probably do a show just on self-employed individuals, because many of our clients and our listeners are entrepreneurs and self-employed, and they have different challenges than people with W-2 income. And again, if you're a self-employed person or entrepreneur, I would encourage you to reach out to Sevy, and he can give you the differences there. It definitely is completely possible and doable. You just have to provide different, there's different requirements, right? So Sevy, tell our Maverick listeners out there how they can get a hold of you, either through social media or email or whatever you'd like. What's the best way to get a hold of you?
Thanks, Tim. I appreciate that. The best way is my phone, honestly. And I do carry that in a catcher's mitt. So when you call or text, and you're going to get a hold of me. Obviously, I'm not always able to answer the first time, but I get right back, of course. So my phone number is 801-755-6260. You can also email me at severin-hughes@comcast.net. The spelling is SEVERYN-HUGHES@comcast.net.
Awesome.
And I do monitor that email all day as well.
And is Severin spelled the same way as Harry Potter? I have to know. Everybody wants to know. The Harry
Everybody
Potter
already
Severin?
does know, because everybody's already asked me that question, Tim.
A million times, right? Yeah. It's actually Severus, right? Not Severin.
Yeah, something like that.
Yeah, very good. Well, Sevy, we sure appreciate you coming on, and we'll post on our website. We'll post your contact information as well, in case people didn't write it down. We love the service you provide people, and we're glad to give us some insights. And we are thankful that all of you were able to listen to this episode and hope it was valuable. We'll see you next time. Thank you so much.
Awesome. Thank you, Tim.